Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good weekend all. Ira Epstein of Linn & Associates with your metals market update for this Friday, the 14th of December. It's hard to believe, boy. We're going to be going on vacation soon, I guess, for the holidays. And we're pushing 340 in the afternoon. So you're still open. Settlement prices have been determined. Look at all the red, the sea of red that we have here in the metal markets. They're just unable to pick up, and here's the culprit. The powerful dollar. It just doesn't back off, and that's been the problem. So as the dollar picks up, what do? It's not a question right now of high interest rates, because if you look at the bonds and the notes, you're not getting them racing to the upside. That is not what's going on. If anything, interest rates have moderated. It's fear. It's the stock market, it's trade fear, it's end of the year fear that's in these markets. You're not getting even energies to stay up here. They fell back again. It doesn't matter if you lose 400,000 barrels a day of Libyan oil. So when we come to the gold, if it could rally, the 18-month moving average of closes, 1270.20, would be the next resistance point. The market's had a pattern of lower highs, lower lows at work for 4 months, 5 months. The resistance is up here. The support's back at 1179.50. Momentum is shown by the slow stochastic is up. Bias is down since you're under the 18-month moving average of closes. And the bigger picture is, if you study these black dashed lines, the Bollinger Bands, you've been going sideways in them, folks, since here, basically, since the middle of 2016. So when the market breaks out of this, it's going to be a son of a gun trade. The question is, which way does it break out? When we look at a weekly area chart of closes, the bias is up. Why? Because you're over the 18-week moving average. When you're over it, you're looking, if you use that as a trigger for other of your technical indicators, you might say, like a flight pilot, this works, that works, let's start the engine. Well, bias up means you're potentially looking for bullish reasons on your indicators. When we take a look at the weekly bar chart with Fibonacci numbers, now it's important to understand our high was up here, 1365 roughly, down to 1161. What the market has done is it's made a 38% retracement. It's taken from August to get that done. We can see that the, if you will, the bias has been to the upside as the market has rallied, and it did get up to the highest high it's made since that time frame. It's still not that impressive, is the problem. When we go to the swing lines, you've got the higher lows, I think you'd agree, and higher highs. Bullish. When we look at moving averages, you got over last week the 200-week average. You came out this week, checked it, and at the end of the week, while we're down $8, we're still above that number. So we're still over that 1233.30, the 200-week average. If you were to get a piece of bullish news, the 100-week comes into play. And if you get anything bearish, the 18-week average comes into play, which isn't all that bad. You want to know why? Because the swing line low is 1210.50, and now your support is going to even jump more when we open Sunday, but it's at 1213.60 going home. Where's the resistance? I could have told you this without anything. Let's go back here. Here you were playing around the market in November. Resistance is the 200-week average, which we set, and right above it are the Bollinger Bands. 95% of the time, the market's going to trade within a Bollinger Band, and the first time you hit it coming out of sideways action, be it to the downside or upside, it very often stops. When it breaks out of that sideways action, I can call this sideways action. It stopped right there. But once it gets going, it's a son of a gun. but it did stop right through there, and that's the important thing. So if it rallies, 1239.60 on this could have been resistance. You went up, you hit it, and the number jumps to 1246.80 because each day that you trade, that number is going to modify. Now you get thrown back this week to the 200-week average and support in that 1213 zone. When we come to momentum, momentum is waning but hasn't turned down. It's still gradually pointing higher. So at this point, the bias is up, the trend is up, and momentum is up. The bulls have control on this chart. And support comes in at the 1213 level. Look for that number to jump Sunday. In the gold-silver ratio, we're seeing a correction from the 86.58 on the weekly chart to 85.45. The base metals, in my opinion, I'm talking the copper, the silver, the platinum, palladium, would all get good bids if this ratio kept dropping down. You need to have that to get that going in those markets. On GLD, the ETF, it's like the futures, higher lows, higher highs, into last week's resistance. This week thrown back from it. That's what I'm seeing. Momentum still pointing up but waning. In the gold miners, if you knew nothing else, I'm sure I would have said if you keep going, the upper Bollinger Band could be your next resistance. You kissed it, you backed off from it, momentum up, trend up, support back here at the 1909 level. Yeah, right in that general zone. Then we get to silver, which looks stronger than gold. It's earlier in the trend. You've got the higher lows, the higher highs. Yes, it's probably going to check out this 18-week average, but the market's turned itself back into the bull camp. If it were to extend the rally, I'd look to wherever the Bollinger Band is. It will drop come Sunday from 1495.80. It might drop 20 cents into the 1475 level because that seems, you know, if you go back a week, you get an idea of what it's doing. If you take a look here, everything's got support between this 1446 level and into this general area. Copper, battleground is the 18-week average. It hits it almost every single week. It hasn't gone anywhere. This is total sideways action. Momentum sideways, the bias is up, the trend is up unless you take out 270.55. Platinum market. Platinum is on the weekly chart bearish. Lower highs, lower lows, momentum still pointing down. Palladium's the strongest on the weekly charts. It just keeps pointing itself higher to new all-time highs. And when we come to the dollar index, wow, that's at new highs for the year too. So you've got a power market there. You put it all together, you try to come up with game plans, and that's my job to teach. And those jobs, I can teach you to do what I do. I really believe that, and I believe I can get it done in a very short period of time. I created hours of videos. I think there's 54 videos, about 6 hours of time. And you do what I do, and you're able to use the same data I do, and then I teach you how to do that. And then I bring you in the mornings to what's going on right now. Then I have webinars on a regular basis, so you can ask questions. You can call. You can write me an email. I will answer. Now, the course normally runs, and I always price it inexpensive, $149.95, $99.95 for the holiday, $50 off. So you want to buy a sweater for the kid, or you want to give somebody something they can learn? That's up to you. It's going to sit in a drawer. They're going to use something the rest of their life, especially if they love charting. $99.95 with the charting software, everything to get them taught. You make that decision. Call my staff. Go to our website under the word education. You can even click up here. It'll take you where you have to go if you're watching me on YouTube. Have a great weekend, all. I'll see you Monday.